Get unlimited access to all of our CPE courses at www.teachucomp.com/unlimited CPE.
In this lesson, we will examine the steps that a business must take in order to claim a deduction for a bad business debt. First, the business must establish that the debt is actually worthless. A debt is considered worthless when there is reasonable evidence to suggest that it will not be repaid. A debt need not be overdue in order to be considered worthless, and a business does not have to go to court to prove that a debt is worthless. However, a business must take reasonable steps to collect the money. If a financial event occurs to the debtor, such as a bankruptcy or insolvency, this is usually a good indication of a worthless debt, even if payment on the debt is not yet due. The specific charge-off method is a way to deduct specific types of bad business debts during the tax year. Using this method, a business can write off the amount that is a bad business debt in the year in which it becomes worthless. In a case where a business previously claimed a bad debt deduction but ultimately recovered the money from the bad debt, the amount recovered must be included in gross income.
Like what you see? Get unlimited access to all of our CPE courses at www.teachucomp.com/unlimited CPE.